Welcome to Subramani. As usual, topics for me are provided by the readers or viewers. So one of them asked me, is it okay to invest in private credit? I have my doubts. I don't invest in credit, in private credit, but I am very clear that all the risk in my portfolio comes only in my equity portfolio. I don't try to get that 0.5%, 1%, etc. Extra in my debt portfolio. My debt portfolio is debt portfolio. No risk, good liquidity. So it could be ultra short bond funds, it could be liquid funds, it could be savings bank account, a lot more in savings bank account than anything else, waiting for opportunity. But I don't even bother too much about shifting into ultra short very easily. I keep a lot of money in savings bank account. That's what I do. I don't invest in private equity, in private debt, which is peer-to-peer lending. A lot of people call up, right? A lot of offers these days. So what has actually happened is the private equity, the private debt, both have boomed. That is peer-to-peer lending. I lend money to somebody in Delhi or somebody in Bombay, and that person is getting money from a lot of people like me. So let's say I put 1 lakh and there are 100 people who put 1 lakh, so that person gets 1 crore, right? So this is peer-to-peer lending. What is happening is it is booming simply because everybody is getting risk-adjusted returns, and we are trying to remove the intermediary. One more way we remove the intermediary in the lending business is by going to the mutual fund. We go and put money in a debt fund. Debt fund goes and buys bonds of companies, which could be used for working capital or for capital expansion, whatever, longer term debt. But mostly it is working capital money, so that the mutual fund is bypassing the bank. Here we are doing P2P lending and trying to bypass the bank, right? So we are trying to get rid of the intermediary. And private equity, private credit has given a lot of good returns. So people are saying, oh, it's a good way to bypass the bank, but I don't know. Let us look at earlier also this product was available to big lenders, right? A mutual fund could do it, a pension fund could do it, a hedge fund could do it. You could raise a fund which would do risk debt, right? So risk debt funds were there, credit risk funds that we used to call them. So private lending is lending by a non-regular lender to a person who is using the money. So what happens is when there are restrictions from RBI, for example, RBI cannot find any way how you can lend to a grocery store or to a restaurant, because saying, look, you are buying things on credit, you are selling things in cash, why do you need credit? Which is a good question. But every business sometimes needs credit. So some small amount of credit, you run a big grocery shop with a lot of stuff, you may need a small time credit which the banker is unable to give. Or the banker is going to say, oh, give me your house, give me your shop, put everything on put everything with me, do deposit of mortgage deed, title and all that. So people find the procedure cumbersome. For example, a grocer with a shop worth 3-4 crores may want 10 lakhs, right? He's not willing to take so much of trouble to get that 10 lakhs. So in steps a private guy and says, okay, here is money for 90 days, here is money for 6 months, here is money for 9 months. I doubt whether private equity guys give for a period longer than that, because they don't have too much of capacity to do a proper risk analysis, right? They are not CIBIL or they are not CRISIL, so they don't know how to do a risk analysis to lend. So short-term lending is what happens. See, following the financial crisis, a lot of restrictions were put on banks internationally and domestically. So a lot of private companies which are into such businesses do not have access to traditional bank accounts in bank credit in even in countries like India, which is a poor country and has slightly different banking norms than let's say the US. And everybody who has banking access to banking finance would obviously take banking finance because it is cheaper. But as a businessman, if you want a quick 10 lakhs and you don't have any great banking relationship, peer-to-peer lending makes more sense, right? So the market for private credit has been booming, and that has been doing very well, and it is expected to be in trillion in the year 2027 it would be at least 1 trillion, and that's not a small market, and that's not a market which can be ignored. And that I'm talking about $1 trillion internationally, not domestically. Domestically, RBI still has some data coming on it, but yes, the market is booming. People like to disintermediate and earn say 12% or 12.5%, whereas in a bank what you will get, even in a good bank, you're going to get something like 7%, right? So you are, by removing the intermediary, you're trying to make that extra 3-4%, but there is no regulatory supervision of what you're doing, so you have to be careful about that too. So why should you invest in private credit? First of all, you get higher yields. So people who are putting big amounts of money in debt would obviously want higher yields. So you get higher yields. There has not been too much of default in this space, or we'll talk about this again, but historically they are saying that it has a lower default rate, and these are short-term duration. You're lending for months, right? You're lending for 8 months, 9 months, which means you're not running a duration risk. If there is an interest rate change, it won't hurt you much. Whereas if you are in a, let's say, a gilt fund, and interest rates are contrarian to what you expect, you will find a mark-to-market loss, right? So you will not find that in this type of private small-time 9-month, 8-month kind of lending. And the chances are you will get a portfolio which is not related to public markets. You cannot find such products in the public market where say they are lending to small companies, etc. That kind of risk portfolio disappeared, especially after one fund house shut down its popular schemes, had to shut down its popular scheme because of liquidity issues. So, but let us also remember that historically low rates means the reporting may not be too great, so that is one thing that you have to worry about. Overall performance of private credit has been good. So what are the disadvantages of investing in private credit? So first of all, illiquidity. If you have lent money, right, each transaction of yours is separate. Suppose I am the person who is managing this P2P lending, so I take from you and I give it to one person. So every loan is a separate loan, and I have taken money from you, maybe say 5 lakhs, and given it to one person for 12 months. Okay, this is at the higher end, so 12 months. You will have to wait for 12 months, because if you want the money, I have to get it back from this person. It's individual transaction. It is not a pool. Because if it's a pool, new money coming in can just go and can be redeemed. So I don't have to redeem from that specific person. But in this case, it has to be redeemed from that specific person. So it is going to be illiquid. But since the whole tenor is only 12 months or 9 months or things like that, you should not worry. But yes, illiquidity is a problem. Transparency is not too great. I mean, they tell you that this is the borrower, etc., etc. One day they'll just say he's defaulted. So there's low transparency. Whereas in a mutual fund, you know exactly where your money has gone, and in the bank, you're not worried, because there is a bank has got to have adequate capital. So when they have enough capital adequacy norms, you really don't care where they invest, as long as their NPAs are very well controlled, right? So if you put money in an SBI, HDFC, CSA, you're not really bothered where they're lending the money, because you will get your money back on the due date with the interest rate, right? You can even get premature. That you can't get, right? Illiquidity is a problem, transparency is a problem, and some deals could come with complex rules which you may not understand much, so you have to be careful about that. Then there is always concentration risk, like there is one person who has lent money and he has lent to a few people. One of them gets stuck, a lot of you lenders will get hit by something like that. So there is this concentration risk. So should you invest in private credit? Answer is yes. There are many people who are doing it for you. You could go P2P lending is not really difficult to find. You will have to obviously register yourself with some investment platform. So once you register there, you get your KYC done. After that, you can start investing. You will have to do some research yourself. You will have to say no to a few and say yes to a few. So then actually go and make a purchase. So I do think that there are advantages, there are disadvantages, but basically public credit is available more easily. Interest rates may be lesser. Private credit is more difficult to do. So I personally would stay away from private credit, but there are private credit funds available. And are private credit and is there listed is there rated paper available? Answer is no. So you have to know all this before you do private credit. So am I recommending private credit? I am recommending private credit. It must be a good source for people though who want that extra return in a debt fund. I don't look for it, so it's not suitable for me. Thank you.